Just a couple of announcements. The QR code that you see up there, won't you just take your phone out and just press the camera and see if it works, you know? And if it does, it's gonna take you to a donate page for Icon and you'll be able to contribute to it. So that's also a nice thing to keep the ball rolling on this amazing summit. As we keep on bringing some icons to the stage, and we keep on talking about the development here in Puerto Rico, we're going to start another conversation, which is going to be of unlocking synergies, talking about federal grants, financial stacking, and tax efficiency. And we want to start welcoming two lawyers, and the first one's going to be Edgar Ríos Méndez. He leads PMA's tax practice with a focus in international tax. Another range of complex federal and international and Puerto Rican tax issues. That's what he tackles. And then we'll also have Francisco Luis. He specializes in post-acquisition integration and strategies to reduce tax rates using Puerto Rico's incentives. So I know y'all had a big lunch, but let me get a round of applause to welcome the next panelists onto the stage.
Buenas tardes. Hi, everyone. It's a pleasure to be here. First of all, I want to thank Icon and Ricky Santana and his whole team for this great opportunity. I'm also honored, and it's also a privilege to share the stage with my dear friend and colleague Edgar Ríos. So we have the task or the mission to wake you up from lunch talking about taxes. So it's going to be a ride. So here's our contact information in case that you need to contact us. I think that Ricky is going to share the presentation. And this is basically the agenda that we have for today. First of all, we're going to talk about Puerto Rico as a tax jurisdiction. That's going to be like the basis to talk to you about the Puerto Rico tax incentives, because this is what has been the main economic development tool for Puerto Rico, for the island. And we're gonna dive into each of the illegal activities. And I run into the presentation. I forgot to let Edgar to present himself.
Well, quickly, I'm Edgar Ríos. I'm a tax partner in PMA. Also honored to be here with Francisco Luis. We have done presentations in the past. And the idea is, as Francisco was saying, to try to give you a general idea of the different tax incentives that we have in Puerto Rico. Some of you, I'm sure, have heard of most of them, but maybe some others you haven't heard. So the idea is to try to convey that and for you to know how many tools you have in the Puerto Rico Incentives Code.
Thank you, Edgar. So in addition to talking about the incentives, we're going to also discuss very important interplay that we have to consider with the federal tax implications because of that particular relation that we have with the U.S. So all of you are here, so you already know about Puerto Rico. Puerto Rico-born individuals are U.S. citizens. We use the same U.S. currency, etc. Puerto Rico has a privileged geographic location. We have direct flights with basically the whole East Coast, with Europe, through Spain, with most Latin American countries as well. And one of the great factors that we have here is that when you do business in Puerto Rico, the individuals and the businesses are not only protected by the Puerto Rico laws and the Puerto Rico Constitution, but also by the U.S. Constitution. And before going into the incentives, we're gonna, this is something that we have to accept. Puerto Rico is a high tax jurisdiction. Puerto Rico individuals, for example, they are subject to regular taxes up to 33%, and you get there really fast. And regular corporations are subject to a gradual tax rate that also climbs up to 37.5%. And on top of that, you have a withholding of 10%. So you're looking at an effective tax rate that is close to 50%. Without incentives. That's why the incentives are so important. And you're going to see that there are diversified eligible activities here. And what is the nature or the cornerstone of the incentives is basically the U.S. tax law, actually. It's in the U.S. tax law that says that Puerto Rico bona fide residents are able to exclude from federal taxation their Puerto Rico source of income. So two keywords there, bona fide resident of Puerto Rico and Puerto Rico source of income. So, for example, if you have bona fide residents of Puerto Rico that their whole income is from sources within Puerto Rico, that individual does not have to file a U.S. tax return. But if you have that individual that receives also income from sources outside of Puerto Rico, that income has to be subject to federal taxation before being subject to tax here in Puerto Rico.
Yeah, that's and that's even, you know, we have been doing this for some time, and even today, people that have been living in Puerto Rico for a very long time still get confused with the fact that the local laws give you a tax benefit in relation to local taxes. But when you live in Puerto Rico, it's the same as when you live in the U.S. in a taxable state, that you have to deal with federal taxes and you deal with state taxes. In Puerto Rico's case, you have to deal with the federal government still, even though you live in Puerto Rico, and you have to deal with Puerto Rico. All the local incentives that we're going to talk today are about, you know, lowering the Puerto Rico tax rates. However, as Francisco was saying, the difference is that when you live in Puerto Rico, you can forget about the U.S. taxes, but only in relation to the Puerto Rico source income. That's the only income that you get to exclude from federal taxes. The way I typically explain this is that when you move to Puerto Rico, you continue to be a U.S. worldwide taxpayer. It's just that the Puerto Rico source income, you get to carve that out of the federal tax system and you can exclude that. But other than that, you have to pay federal taxes even though you're a bona fide resident of Puerto Rico in relation to income that is not from Puerto Rico sources. So that's very important to understand. People tend to refer to, well, but I have an Act 60 decree. Why do I have to pay federal taxes? Well, you have to pay federal taxes because even though you have an Act 60 decree, the income that you're receiving is not from Puerto Rico sources. And even though Act 60 can lower that to zero, you still have to pay federal taxes if the income is not from Puerto Rico sources. And that's a common, you know, a common mistake that people make.
Exactly, Edgar. And when you talk about being a bona fide resident of Puerto Rico, you have to define that within the two jurisdictions, the U.S. jurisdiction and the Puerto Rico jurisdiction. And both jurisdictions have different definitions for what is being a bona fide resident of Puerto Rico. So that's something also that you have to consider. And when we talk about the source of income, depending on which type of income you're earning, is going to be the sourcing. And that's, we're not going to get technical, but for example, when you perform services, if those services are being performed in Puerto Rico, that's source where the service is being performed. So it's Puerto Rico source. And you're going to see some interesting activities with respect to services. But for example, in the case of dividends or interest, whoever is the payer, and this is a general rule, whoever is the payer will trigger the sourcing. So you can be a resident of Puerto Rico, but if you receive dividends from sources from outside of Puerto Rico, that's going to be non-Puerto Rico source, so you have to include that in a federal tax returns. So that's with respect to the individuals. With respect to entities that are organized in Puerto Rico, look how curious is this, because Puerto Rico-born individuals are U.S. citizens, but entities that are organized in Puerto Rico are considered foreign for U.S. tax purposes. And that provides a fiscal autonomy to those entities that are doing business here in Puerto Rico. And that's basically one of the advantages that you have, that you can have U.S. citizens doing business here in Puerto Rico protected by the U.S. Constitution, but those entities are not subject to federal taxation unless they engage in a business in the U.S. So that's basically like the source of how the incentives work. Let's go into the incentives now. Probably you have heard about Act 20, Act 22, Act 73. Those, we used to have different incentives laws that provide incentives, tax incentives to different eligible activities. Act 73 for manufacturing, Act 22 for new residents, Act 20 for export activities. During the summer of 2019, all of those incentives acts migrated into Act 60. And now we have different chapters in Act 60, and the purpose was to combine all of those incentives and to have a more standard offering with respect to the eligible activities that we have. And this is basically the different chapters that we have in the incentives code. The incentive code has approximately like 400 pages. So each of the incentives have several definitions and discussion about the activities. So this is very deep with respect to the analysis that you have to do. But for example, there's a chapter for individuals. That's one of the main that we're seeing. That's the one to attract new residents to the island. But also there's an incentive for example, if you have a decree, a tax decree, that's the contract that will seal the incentives between the government of Puerto Rico and the recipient of the incentives. If you have a tax decree for any of these activities, and you need to bring someone from outside of Puerto Rico because you need that particular expertise here in Puerto Rico, there's also an incentive for that individual that you're bringing. And the incentive is that any compensation that you pay to that individual in excess of $100,000 is going to be totally exempt for him. And that's going to be valid for 15 years. With respect to the incentives for the new residents, basically Puerto Rico will grant a total exemption on 3 types of income: dividend income, interest income, and certain capital gains. Certain capital gains because those capital gains have to be earned from the sale of a security. And we have a definition about what is a security. But basically stocks, bonds, shares, etc. But going back to the dividends and the interest, remember what I mentioned when we were discussing about the sourcing. You can have, for example, stocks from Apple or Starbucks. I mean, if you receive dividends, that's going to be non-Puerto Rico source. So even though it's going to be exempt in Puerto Rico, it's going to be subject to federal taxation. But for example, if you have a capital gain by selling those stocks and you acquire those after you move to Puerto Rico, that's going to be sourced in Puerto Rico, and it's going to be exempt under this chapter.
Yeah. And I don't know, Francisco, if you can fast forward to the next slide, just to then come back, which is that all those incentives that Francisco was showing, which are separated, I'll say industry by industry, and all those, the idea of the tax incentives code was to make them uniform across all the incentives, because before, when we had separate laws, there were different incentives. There was one law that provided a 90% exemption. There was another providing a 4% tax. So instead of doing that, what the incentives code tried to do is try to make the same incentives across all the different industries. So what Francisco is showing here basically is all the favorable benefits that you get under those laws. There are other benefits, but the main ones are these ones: that you get a 4% tax rate for your income, that if you have to pay royalties because you're using intangible property in Puerto Rico and you're licensing that, the withholding on that for the licensor is just going to be 12%. And if you, instead of being 29%, so it's lowering our typical tax rate of 29 to 12. And in terms of property taxes, provides for a 75% exemption. Municipal taxes, which are basically taxes for the privilege of operating in one of the 78 municipalities in Puerto Rico, you have a tax for that, but that's exempted in 50%. And sales and use tax, you have 100% exemption in relation to materials and equipment that you purchase for the exempt business. And so those are the basic benefits that you get for all the industries. So going back to the industries really quickly, Francisco spoke about the individuals, but as you know, and some of you do have tax decrees for export services. Fairly quickly, export services means that you have a company operating in Puerto Rico that is providing services to a client located outside of Puerto Rico. As Francisco explained before, if you have a company that is operating in Puerto Rico, organized in Puerto Rico, that company is operating outside of the United States, and therefore that company is not subject to US taxes unless the company operates in the US. So let's assume for a second that the company is solely operating in Puerto Rico. The company will solely pay a 4% tax in Puerto Rico. And as Francisco was explaining before, so long as those services are provided in Puerto Rico, that's generating Puerto Rico source income, and it's generating Puerto Rico source income outside of the United States, because Puerto Rico, for those purposes, is not the United States, and therefore there's no US tax, and you truly enjoy the 4% tax. So on that export services, you have a 4% tax at the entity level, and then distributions are taxed at 0. So you have no tax. So it's very efficient so long as you can provide the services from Puerto Rico. So that's export services. Financial and insurance services, Puerto Rico also has a regime for companies that provide banking-like services that is known as the international financial entities. Those international financial entities also enjoy a 4% tax rate so long as they're providing these financial services from Puerto Rico to clients located outside of Puerto Rico. Same thing with insurance. You can underwrite insurance from Puerto Rico and have and issue policies from Puerto Rico for risks located outside of Puerto Rico, and that also will be subject to the 4%, the 75%, the 50% exemptions that we saw before. And also under this chapter, there's a concept that is called private equity funds. That private equity fund concept, in essence, rewards private equity funds for basically raising capital and investing at least 60% of the capital in Puerto Rico. You get certain benefits for doing that. So that's within that financial and insurance services chapter. And then we have the visitors economy. That's a chapter that deals with the incentives for tourism. So for example, this hotel that we're here today, it was built on enjoying these tax benefits for tourism. That one includes a very special benefit, which is tax credits, that you get a 40% tax credit for the construction costs associated to the tourism development. So for example, this hotel was built and was subsidized in part with the credits. And I remember that the amount of credits that were generated for this hotel was very high. So you get 40% of all your construction costs in credits if you're doing that under the visitors economy. The other chapter, which is manufacturing, I will let Francisco talk about, but manufacturing is kind of the original one, I'll say, where everything kind of got copied from manufacturing. Manufacturing is kind of our original incentives here in Puerto Rico, right, Francisco?
Correct, Edgar. Actually, manufacturing was and still is the main industry in Puerto Rico. And the incentives for manufacturing has been there for close to 100 years. That's how in the last century, Puerto Rico transitioned from the agriculture to the industrialization. When the big farmers and the big manufacturing came to Puerto Rico, now that has been expanded to bio, to aerospace, etc. And it's a huge industry. And for example, one of the main advantages with manufacturing is that even though that is being done by a foreign entity for purposes of the US, whatever is manufactured here in Puerto Rico goes out with the seal of made in the USA. And that plays a great advantage for purposes of Puerto Rico vis-a-vis Singapore, Ireland, India, China, which are the big competitors attracting manufacturing offshore from the US. And another activity that we see a lot with manufacturing is research and development activities, R&D, that also provides a tax credit like the one that Edgar mentioned about tourism activities. 50% of whatever you incur in R&D activities during the year, you get a tax credit. And the beauty of these tax credits is that you can monetize them. You can sell them in the secondary market at a discount, let's say 98, 96, 95%, and you get that cash back tax-free. There is a huge market for these tax credits. But now when Act 73, which was the prior manufacturing incentives law, migrated into the incentives code, now the R&D activities are expanded to any activities within the incentives code. So for example, we have seen a lot of export services that are engaged in technology that are doing R&D activities and are enjoying the benefits of the tax credits. Another eligible activity that we have in the incentives code is infrastructure. The main activity there that is covered is green energy. Puerto Rico has a goal that by year 2050, it has to be fully off the grid in terms of green energy. That's a high-level mission, but that's, I mean, one of the incentives that they are trying to provide. Agriculture still is an industry that is covered by the incentives, similar benefits to the rest. Creative industries, those are incentives for basically the entertainment industry. For example, film production that is done here in Puerto Rico receives incentives. And also, for example, we have seen a lot of local artists that are exporting royalties, and they are seeking incentives within this chapter as well.
That's right. And last, the last ones, which is entrepreneurship, that one I'll say, which could be relevant if you have people employed that are young in your companies. There's an incentive that, well, there are two. One is not in the incentives code, but I'll mention it anyway, which is that if you hire someone that is in the ages between 16 and 26, the first $40,000 that they make is exempt. And so normally, we in the law firm that we have people that are below, under 26, in essence, you don't have to withhold any income taxes from them. So for them, it's very advantageous until they get to 26. Then there's one dealing with entrepreneurship, which is that if you're a young person between 16 and 35, so I'm out of that. But anyway, if you're between 16 and 35, if you start a business that is a new business, you get basically the first $500,000 exempt. You get no property taxes, no municipal taxes for the first 3 years. So there's some incentives for young entrepreneurs to start their business, and so long as they are between 16 and 35, they can go and apply for a tax decree, and they'll get that protection for the first 3 years.
One clarification, Edgar, with respect to the young entrepreneur is that it doesn't have to be, that entrepreneur does not have to engage in any of these activities. It can be activities outside of the incentives code. So whatever he's doing or she's doing, it's going to be eligible, and you can seek a decree.
Yeah, that's right. For example, if he's opening a retail shop for selling hats, he can apply for that, or she. So that's one that the incentives code also covers. And then there's opportunity zones. Some of you might be familiar with opportunity zones. In essence, what we did, we copy the U.S. law, and we try to we try to improve that. So in the U.S., you have opportunity zones, which basically all they do is that if you have a capital gain, you can roll over that capital gain in order to avoid paying taxes on your capital gains. That's what you do under opportunity zones. You just roll them over. And in essence, so long as you keep the investment for 10 years, then any appreciation on that initial investment is tax-free, right? But the first capital gain, you get to tax that. I think by 2026, you pay the tax on the deferred capital gain. But any appreciation on that capital gain, so long as you keep it for 10 years, is totally exempt. Puerto Rico has the same regime, but also Puerto Rico basically provides, if you're doing a business in an opportunity zone, you get a lower tax rate. You get 18.5%. So let's assume that you're doing something that is not covered under these incentives, but you're doing your business within an opportunity zone, and understanding that 94% of the island is within the opportunity zone map. So pretty much anywhere, unless those very high pricey areas, will be an opportunity zone. And therefore, you can do any business within those zones, and the tax rate will be 18.5% as opposed to being, 45% or something close to that. So opportunity zones, a good incentive. It hasn't been used as much, but we have seen a couple lately that have been established around San Juan and other areas. I think that covers pretty much what the incentives code provides. I think we want to mention a couple points as to the importance of the interaction between the U.S. and Puerto Rico, because it's important that when you are considering doing business in Puerto Rico, you go and talk to your advisor about the incentives code and what the benefits it provides. but because our close relationship with the US and the fact that most of you are US citizens, that has something that is you always need to consider when you're planning. And I'll let Francisco start with that.
Yeah, certainly. I mean, you cannot consider the incentives without looking at the federal tax implications because they are very complex rules and they apply. So, for example, let's say that you have your business. Let's say that you have a manufacturing business in the U.S. and you're looking now into these activities and I want to move that to Puerto Rico. Well, careful with that because, for example, moving something from the U.S. to any outside jurisdiction, that's like an outbound. I may have a taxable event that you have to value whatever you're exporting or outbounding, and you have to pay federal taxes on that. And in addition to that, there are some complex inversion rules that, for example, let's say that you have that manufacturing plant in the U.S., and you say, I'm not going to move it to Puerto Rico. I'm going to shut it down here, and I'm going to open the same in Puerto Rico. Well, the IRS will look at that and will say, this is an inversion of whatever you have in the U.S., so it's going to still be subject to federal taxes. There are ways to do some planning to see how you can establish new functions in Puerto Rico, and you can get the benefit of the incentives, but certainly you have to plan before that. Another area is, because we have talked about services, and I mentioned that wherever the place where you are providing the service, you trigger the sourcing. So for example, let's say that you are exporting services from Puerto Rico, but you have to do some ancillary services in the US as part of that export services, you're gonna be subject to federal taxation on those activities that you are doing in the US. And the challenge there will be, how are you gonna split the revenue that you're earning from whatever you are doing in the US and in Puerto Rico?
Yeah, in essence, say in a different fashion, when you're moving to Puerto Rico and you have created value in the US, you cannot just move to Puerto Rico or to China or Spain or anywhere. The US has some rules that if you're taking that value out of the US, they will impose kind of a toll gate tax, right? They will say, how much value you created that now you are moving outside of the US, you have to pay me now before you migrate outside of the US, and they will collect a tax as to what that value was. So people that are moving to Puerto Rico have to consider that, whether there's some value that was created in the US and somehow whether it can be understood that that value is being transferred outside of the US without paying a tax. That's one. And then the other one is the transfer pricing that those transfer pricing rules, what I'm saying is that if you're providing services between Puerto Rico or anywhere outside of the United States and the US, you have to really value how much income is being earned in Puerto Rico versus how much income is being earned in the US. And it's really solely the one that is created in Puerto Rico. That value is the one that is going to escape the US tax, is going to be just taxed at 4%. But whatever value still is created in the US will continue to be subject to US taxes. That's the importance of the transfer pricing.
Certainly, Edgar, that's very important that you have to consider when you have businesses that you own and control in Puerto Rico with these incentives and in the US. It will be too easy to charge whatever you want to charge from Puerto Rico to your business in the US just to shift income to Puerto Rico. But I mean, the IRS will look at that as shifting of income per se. And you can charge services from Puerto Rico to your business in the US, but you have to be subject to a transfer pricing study. It's like an appraisal that you have to demonstrate that those transactions are considered arm's length. Otherwise, you will be subject to penalties, huge fines in the US for not doing that transfer pricing study. The ownership. Now, another area that you have to consider, and we have just 2 minutes to go, is the ownership of the entity. For example, we have seen entities being organized in Puerto Rico that have a mix of investors, local investors or new residents that came to the island, and US persons as well. If you have more than 50% of ownership that remains in the US, be careful as well, because that entity, remember that the entities in Puerto Rico are considered foreign, that entity is going to be considered for US tax purposes a controlled foreign corporation, and it basically it may destroy the deferred structure that you have with a corporation, meaning that those U.S. persons may be subject to federal taxation. Edgar, any other comment on that?
Yeah, yeah. The important thing is that, as to that, and just to, even though we don't want to go into that level of detail, is that the advantage of residing in Puerto Rico is that if you reside in Puerto Rico, even though you're a U.S. citizen, for that test of controlled foreign corporation, you're not counted as a U.S. person in relation to a Puerto Rican entity. So that's a big advantage that you will not find anywhere. And so long as you have the people of Puerto Rico truly controlling the entity in terms of vote and value, then you escape those rules. But if you have U.S. persons who are not residing in Puerto Rico controlling a Puerto Rican entity, then you're subject to those controlled foreign corporation rules, and that's important to know and discuss with your advisor.
Yeah, certainly. Well, 16 seconds not to go. So, but we have time for questions in case that you have
I
a
think.
question there. I don't see with the light.
Well, first, thanks for a wonderful summary on this super complex subject. Intentionally dumb question to some extent. So with respect to individuals and the Act 60, you mentioned there is application process, right? Hacienda has some forms, you need to go fill in some forms. What confuses me is, imagine you do not fill in those forms, but you have tangible evidence that you're a resident, you live here, you have activity here. What's the role of this whole application process in using the benefits? Could you be subject to those basic benefits that you showed, 15 years of 4%, et cetera, without the application, or it's strictly mandatory?
That's a very good question, and thanks for asking. And basically, I mean, let's say, for example, that you move to Puerto Rico and you're complying with residency for U.S. purposes, for Puerto Rico, et cetera, and you are trying to seek advantage of those incentives. You will not have the incentives unless you apply for the tax decree. And that holds true for any of the eligible activities. Let's say, for example, that you are manufacturing in Puerto Rico, but you have not applied for the incentives and you don't have a tax decree, then you are not going to be eligible for the incentives. And that tax decree is a contract, and you have to comply with all of the formalities of the contract. And one of the formalities is that you have to be in good standing with the governmental agencies in Puerto Rico, so you have to complete your filings, etc. Otherwise, that may be a reason to discharge the decree.
Edgar, Francisco, always a pleasure to see you. Francisco Martorell Kiki. You made a comment about being careful about moving property assets from the U.S. mainland to Puerto Rico and the possibility of a toll gate tax. I just wanted to validate, if investors in Puerto Rico, we decide to buy majority control of a company in the U.S., to bring it to Puerto Rico and conduct its business from Puerto Rico, outside of Puerto Rico, including the U.S., you would not be subject to that toll gate tax. Is that assumption correct?
Yeah, I'll take a stab. It still could be applicable. The question becomes, so if I understood that correctly, you have investors from Puerto Rico that they go and buy an asset in the U.S., a company, and then they decide that they're going to bring that company now because you have a Puerto Rican investor base. They're going to bring part of that company or a significant operations of that company in Puerto Rico. And the answer is that the particular section that Francisco mentioned before, which is inversion, is a section that is not quite clear how the U.S. will apply that. So far they have used that particular section to companies that are multinationals, right? And the idea is that if you, and there's a famous case dealing with Burger King. They basically, Burger King was trading in the U.S. stock exchange, and they changed their charter to Canada because that saved a bunch of taxes. And what the section says is that if you were a U.S. owner and you became an owner of the foreign company by the mere fact that you were an owner of the U.S. company, you enter into this exchange, then the section will apply. Now, that's a more complex section, so I would think that in your particular case, that one will not be triggered because you are bringing meaningful operations to Puerto Rico and you are doing a business from here to outside of Puerto Rico, and therefore there's exception for when you bring business to Puerto Rico and you do business in Puerto Rico and you do business for outside of Puerto Rico. But when you do meaningful business in Puerto Rico, that will be excluded from that particular tax. Now, there's still the other tax that we talked about, which is that you have a particular asset and you migrate that asset to Puerto Rico. Let's take your example, Kiki. You purchase a U.S. company, and that U.S. company, for whatever reason, has an IP that now you want to move to Puerto Rico, that IP, because you heard in this conference that if you do research and development in Puerto Rico, you get a 50% credit. So you're saying, well, let me get that IP to Puerto Rico and do some research and development, and that will be subsidized. But the title holder is going to be changed from a U.S. entity to a Puerto Rican entity. If you do that, there'll be a tax on the appreciation of that transfer. So normally what people do, they'll have to value that IP and purchase that IP. And one good thing to know is that part of the purchase is also subsidized with the credit. But you will do it not for the credit, you will do it for U.S. reasons that if you don't do that now and purchase that at the value today, the IRS will have the hindsight that if later this becomes very successful, then it's very hard to say how much it was valued 4 years before, right? They will have the benefit of hindsight. So you want to take a position that you purchase that for the fair market value, pay the U.S. tax, which is the value that was created in the U.S., and now enter into the R&D and get the subsidy for the credit and so on and so forth. So when in your particular situation that you have a company that will be doing business in Puerto Rico, business outside of Puerto Rico, now based in part in Puerto Rico, the inversion should not be much of a concern, although still need to be studied to make sure that you don't trip that one. But the other one, which is that any asset that you have a built-in gain that you now are moving title of that asset to Puerto Rico, that you have to pay the exit tax and make sure that you pay that appreciation. The other one requires careful consideration, but the one that you will never escape will be that one that the built-in gain will be subject to a tax when you migrate.
Any other questions?
We have 3 solid minutes.
Sure. Normally, it's an accounting firm, the one that do, but for example, in the US, you have several boutique firms that only do transfer pricing studies. But in terms of materiality, there's no threshold. So whenever you have transactions among related entities in different jurisdictions, that has to be covered by a transfer pricing study.
And what a transfer pricing does, which is an important question, is that it will not save you from, it's not a complete shield, but it will save you that at least you took a reasonable position. Some penalties are, the U.S. Internal Revenue Code provides specifically that some penalties will not apply if you have a transfer pricing study. So transfer pricing study will protect you from some penalties. And more so, anything that is associated to anything that could be criminal, anything that obviously there'll be no ill will or bad intention because you were diligent in getting the transfer pricing study. So transfer pricing study is a good way of protecting yourself that you made a good effort to try to value what was created in Puerto Rico versus the value that is produced in the U.S., and you're trying to pay your fair share to Puerto Rico and the fair share to the U.S. So that's something that's important because of that.
Yeah, and what the regulations require is that study has to be enforced when you file the U.S. tax return. You don't have to submit that like other jurisdictions. You will keep that transfer pricing study. In case of a challenge or an audit, then you show the study. But even though, for example, let's say that you don't have the study complete, that you have a benchmarking, and you file your tax return, and the IRS comes and you complete then the transfer pricing studies, and you demonstrated that the fees that you were charged were correct, you will not avoid the penalties or the fines because you have, the regulation said that you have to have that enforced when you file the tax return.
Okay, yeah, I got a question for you. So, as a healthcare center, Here we go. As a healthcare provider coming to Puerto Rico, now that they put the carve out for medical providers on hiatus for Lord knows why, what are the best avenues to create or get access to those tax benefits when a healthcare provider comes to Puerto Rico?
Well, if that provider is under 35 years old, it at least has the young entrepreneur incentive that Edgar mentioned. But other than that, I mean, we don't have any more incentives for them. And those incentives are still enforced in the law. It's just that the fiscal board stopped the program. So it's a matter of see what happens in the future.
Yeah, and just to repeat what Francisco said is that even though you're a doctor and you're going to open up your practice and your business in Puerto Rico, you no longer have, and you were referring to physicians that before and now they don't have that benefit anymore. They had the benefit of the ones that applied for the decree before the benefits were halted. They do continue to have these 4% benefits. So those that apply for the benefit continue to have the 4% for 15 years. But it's just that new applications are not available. Now, you still can apply if you're opening a new business, you're opening your practice in Puerto Rico, and you're in the ages between 60, well, it's a doctor, so it'll be closer to 35, below 35. You can apply for the young entrepreneur benefit of exempting the first 500,000 for the first 3 years.
Exactly.
If that healthcare provider is an organization instead of an individual, it can apply for medical tourism?
Yeah. Medical tourism is one of the eligible activities that we have in the export services chapter. So yeah.
Yeah.
Tourism.
The only thing, and I'll say this very quickly, is that is available so long as the patients that are being tended to are non-residents of Puerto Rico. So it's available, but it has to be for patients that do not reside in Puerto Rico. And if you do that, yes, you get a 4% on the income that you generate out of those patients that are not residing in Puerto Rico that come and visit. And we have some of those that are coming from the islands. And so that still is available.
And you can combine. You can provide services to Puerto Rico and to tourism, and the portion that you are earning from the tourism, that's the one that is going to be subject to the 4% tax.
All right, that's all the time we have for the questions. For the gentleman up here, please, a big round of applause. Great talk on synergies, a lot of education.